Most people are gazing directly at the indicators, yet they don't perceive them. They're observing numbers, reacting to commotion, pursuing perspectives, but overlooking the communication underneath it all. Silver and gold have always communicated quietly, never loudly, never emotionally. They don't plead for attention. They reflect conduct, confidence, fear, discipline, and long-term reasoning. And presently, they're communicating something most people are completely unprepared to comprehend. I recall recognizing early on that the most substantial shifts in existence don't announce themselves. They occur while the majority is distracted. While people debate over perspectives, fundamentals continue shifting. While attention jumps from one thing to another, worth remains patient. That's how it has always been. Those who master interpreting indicators instead of headlines gain an advantage that feels almost unjust. Yet it's accessible to anyone willing to decelerate and reason. Silver and gold aren't about excitement, they're about truth. They expose the distinction between short-term reasoning and long-term vision. When people are confident, they disregard them. When people are uncertain, they rediscover them. This sequence isn't random, it reflects human psychology. It demonstrates where trust is shifting and where stability is being quietly reevaluated. Accomplished investors didn't construct prosperity by reacting. They constructed it by observing sequences others dismissed as tedious. They comprehended cycles. They comprehended that when something ancient continues to matter in modern systems, it's not accidental, it's foundational. Gold and silver don't forecast the future. They disclose the present more honestly than most indicators ever could. The genuine signal here isn't about price, it's about mentality. It's about preparedness versus dependence. People who depend entirely on external systems tend to overlook concrete worth. People who value independence tend to notice it early. This applies to currency, careers, and personal development. Those who develop abilities, assets, and discipline don't panic when circumstances transform. They adapt. Consider entrepreneurs who constructed during uncertainty. They didn't await perfect clarity. They interpreted the environment. They positioned themselves quietly. They invested in resilience instead of exaggeration. Silver and gold reward that identical mentality. They favor those who reason in decades, not weeks. Here's the practical shift most people need to make. Cease questioning what's exciting and begin questioning what's essential. Cease pursuing movement and begin constructing stability. Diversify your efforts. Protect your downside. Invest in things that don't require permission to maintain worth. That might mean allocating responsibly, decreasing unnecessary risk, or simply committing to consistent practices instead of emotional determinations. Every substantial transformation begins internally. When you train yourself to recognize indicators instead of reacting to commotion, your decision-making improves across the board. You become more composed. You become clearer. You cease rushing. That alone positions you ahead of most people. Silver and gold are signaling patience, discipline, and long-term awareness. They're reminding those who are paying attention that genuine prosperity isn't constructed by speed, but by alignment. Alignment between mentality, behavior, and time. If this communication assisted you in perceiving things differently, support the channel by engaging with the content, subscribing, and sharing it with someone who's ready to reason beyond the surface. Remain concentrated, remain grounded, and remember, those who master interpreting the indicators early don't need to rush later. Do you recall when they informed you that silver was merely another commodity? Do you recall when the commentators on financial television stated that precious metals were remnants of a past era? Do you recall when your broker dismissed your interest in physical assets as paranoia? Nobody is dismissing it today. It's Monday, January 19th, 2026. And if you've been observing the retail bullion market over the past 72 hours, you've witnessed something that has never occurred before in modern precious metals history. We're not discussing price action. We're discussing infrastructure failure. The largest precious metals dealer in the United States just transmitted an emergency communication to its customer base. COMEX, a company that processes hundreds of millions of dollars in transactions every single month, has instituted a $500 minimum purchase requirement for all online orders. Let that absorb for a moment. $500 minimum. You cannot purchase a single tube of Eagles. You cannot acquire 10 ounces of generic rounds. You cannot place an order unless you cross a threshold that would have been considered absurd 6 months ago. But this isn't where the narrative ends. This is where it begins. Because 4 days before that announcement, the same company imposed a $10,000 minimum on buybacks. If you want to liquidate your silver back to COMEX, you must send them at least $10,000 worth of metal before they'll accept it. We're witnessing the retail distribution system fracturing under pressure it was never designed to handle. The infrastructure is breaking. The infrastructure that connects miners to refiners to wholesalers to dealers to your doorstep is failing in present time. And the most alarming aspect? This is occurring while silver sits at $93 per ounce. Not 100, not 150, 93. What occurs when we hit triple digits? What occurs when the price doubles from here? If the system is breaking at 93, where will it be at 200? The retail apocalypse isn't a future occurrence. It's happening presently. And in the next several minutes, we're going to examine the mechanics of why this collapse was inevitable, why it's accelerating, and why the window to acquire physical metal through normal channels is closing faster than anyone in the mainstream is willing to acknowledge. We need to comprehend what we're actually observing. Because when a headline states that APMEX instituted a $500 minimum, most people treat it like a policy adjustment. They think it's a business determination made to improve efficiency or streamline operations. It's not. This is a distress signal. This is a company that's drowning in order volume and cannot process the flood. Let me provide you the numbers directly from the Chief Executive Officer's letter. Last week, from an order count perspective, was the fourth highest week in APMEX history. Fourth highest. Not fourth highest this year, not fourth highest in recent memory, fourth highest ever. That number was 40% higher than the week before. The average order count for APMEX under normal market circumstances is roughly half of what they experienced last week. They're running at 200% capacity. Their infrastructure, their staffing, their inventory management systems, their shipping logistics, all of it was constructed for a different world. A world where silver traded between $20 and $30. A world where demand was stable and predictable. That world is gone. But here's where it deteriorates. On the buyback side, they imposed a $10,000 minimum 4 days earlier. Even with that restriction cutting off 20% of incoming buyback tickets, purchasing volume is still in the top 5 in company history. Let me translate that. Even after instructing small sellers to go away, APMEX is still being overwhelmed by people attempting to liquidate metal back to them. Why? Because the price has shifted so far so rapidly that retail holders are panicking. They're accepting profits. They're liquidating. And the dealers cannot handle the flow. So you have two tsunamis colliding. On one side, you have record purchasing. On the other side, you have record liquidating. And in the middle, you have a distribution system that was never engineered for this level of bidirectional chaos. The $500 minimum isn't about profit, it's about survival. Every small order requires the identical amount of administrative labor as a large order. Someone has to process the payment. Someone has to pull inventory. Someone has to package the shipment. Someone has to generate tracking. When you're handling twice your normal order volume, every single low-dollar transaction is a drag on the system. APMEX is attempting to cut the bottom 50% of transactions by order count so they can concentrate resources on the top 50% by dollar volume. It's triage, it's a battlefield determination, and it indicates everything you need to understand about the condition of the retail market. But there's another piece of this puzzle that most people are overlooking. APMEX operates their own private mint. They produce 90% of the silver bars and rounds that they liquidate under their house brand. This provides them a massive advantage over competitors who depend entirely on third-party suppliers. They command their own production. They can respond to demand faster than anyone else in the industry. And yet, even with that advantage, their output has been cut by 50%. 50%. Their mint is running at half capacity. Why? Because they cannot source enough blank planchets. They cannot obtain enough raw silver feedstock to maintain the presses running. The refining bottleneck is genuine. The refiners are running 24/7. They're turning away new orders. They're prioritizing long-term contracts with industrial users. And the retail dealers are being squeezed. So APMEX is now warning customers that silver product pre-sale dates will be 3 to 5 days longer than the previous week. And the previous week was already delayed. We're not discussing a temporary backlog. We're discussing a structural breakdown in the supply chain. The system is collapsing, and this is just one dealer. Now, question yourself, if APMEX is struggling, what's occurring to the smaller regional dealers? What's occurring to the coin shops that don't possess private mints? What's occurring to the online retailers that depend entirely on wholesaler inventory? They're being crushed. Some of them have ceased accepting orders altogether. Some of them have pulled their pricing off their websites. Some of them are only liquidating to existing customers. The retail infrastructure is disintegrating, and the price is still climbing. Now we have to address the question that's screaming inside your head presently. Why is this occurring? Why is the retail system failing at $93 when it functioned perfectly fine at $30? The answer isn't merely about price, it's about velocity. It's about the speed of the movement and the psychology it generates. Silver initiated this year at roughly $71 per ounce. We're 19 days into the year. In those 19 days, the price has climbed 31%. If you annualize that rate of return, you obtain numbers that break every historical model. This isn't a bull market. This is a melt-up. This is a market that's remonetizing in present time. And when an asset shifts this rapidly, it attracts two types of purchasers. The first type is the industrial user. These are the companies that need physical silver to manufacture products. Solar panel companies, electric vehicle manufacturers, data center operators. These purchasers have no selection. They must possess the metal or their production lines shut down. They don't care about price, they care about availability. and they're bypassing the retail market entirely. They're going directly to refiners. They're signing offtake agreements. They're securing supply before it ever hits the open market. This is why COMEX inventories are draining even as prices elevate. The metal is being pulled into industrial stockpiles. It's being eliminated from circulation. The second type of purchaser is the speculator. These are the people who perceive a 31% gain in 19 days and think the celebration is just initiating. They're not purchasing because they comprehend monetary history. They're purchasing because the chart is going vertical and they desire exposure. They're leveraging up. They're maxing out credit cards. They're liquidating stock portfolios. They're pouring into ETFs and futures contracts, and a significant portion of them are demanding physical delivery. This generates a problem that the retail system was never designed to solve. In a normal market, 95% of silver transactions are paper, ETF shares, futures contracts, unallocated pool accounts. Only 5% of purchasers actually accept delivery of metal. But when the price goes parabolic, that ratio flips. Suddenly, 20 or 30% of purchasers are demanding physical. They don't trust the paper. They've read the prospectuses. They understand about cash settlement clauses. They desire the metal in their hands. And the retail dealers cannot source enough inventory to satisfy this surge in physical demand. So they elevate premiums. They extend delivery times. They impose order minimums. They execute whatever they can to decelerate the flow, but it's not functioning. Because on the other side of the equation, you have the profit takers. You have the stackers who purchased at $25 and are now sitting on 300% gains. They're liquidating. They're liquidating portions of their stack. They're accepting chips off the table, and they're flooding the dealers with buyback requests. Normally, this would be favorable for the dealers. They would purchase low from the public and liquidate high to new customers. But the volume is so extreme that they cannot process it. They don't possess enough staff. They don't possess enough warehouse space. They don't possess enough cash on hand to settle all the buyback requests. So they impose a $10,000 minimum. They're instructing small sellers to go somewhere else, but there's nowhere else to go. The local coin shops are overwhelmed. The pawn shops don't possess liquidity. The online competitors possess the identical restrictions. So the sellers are trapped and the purchasers are trapped. The dealers are caught in the middle attempting to manage chaos with systems that were constructed for stability. This is what infrastructure failure resembles. It's not dramatic. It's not cinematic. It's just slow motion collapse as every node in the network reaches its breaking point simultaneously. And we're only at $93. The genuine chaos hasn't even initiated yet. Let me demonstrate what's occurring outside the retail sector, because the pressure on APMEX is merely a symptom of a much larger disease. The United States Mint just executed the most aggressive repricing occurrence in its modern history, and almost nobody is discussing it. 1 week ago, the Mint was liquidating collectible proof silver eagles for $95 per ounce. Today, they're requesting $173. That's an 82% price increase in 7 days. Let me state that again. The United States Mint elevated prices by 82% in 1 week. Backdated uncirculated silver eagles went from $91 to $169, an 86% jump. Presidential silver medals went from $90 to $164 overnight. These aren't bullion products. These are numismatic collectibles that carry high premiums under normal circumstances. But an 82% hike in a single week isn't normal. This is panic pricing. Now, the Mint will inform you that they need time to adjust their pricing models. They'll state that they're simply catching up to market realities. But let me provide you a piece of context that destroys that narrative. When I spoke to Mint representatives 2 weeks ago, they informed me it would require 30 days to implement new pricing. 30 days. That's their standard procedure. But they just executed it in 7. Why? Because they were getting arbitraged into oblivion. Purchasers were purchasing numismatic silver from the Mint at $90 per ounce and immediately flipping it on the secondary market for $120 or $130. The Mint was subsidizing flippers. They were liquidating silver below replacement cost, and they couldn't sustain it. So they pulled everything offline, recalculated, and came back with prices that reflect where they think silver is going, not where it is today. Consider what $173 per ounce means. That's the price the United States government believes it needs to charge to avoid losses on future inventory. They're pricing in a continued rally. They're assuming that spot silver is going to 100, 120, 150 or higher, and they're front-running it. But here's the truly disturbing aspect. Even at $173, the products are sold out. You cannot purchase them. The Mint website demonstrates them as unavailable because the Mint doesn't possess the blanks. They don't possess the raw planchets to strike new coins. They're dependent on the identical refining network that's failing APMEX. They're competing for the identical limited supply of refined silver, and they're losing. So they've halted sales of numismatic products. They've ceased accepting orders. The only thing still available from the mint is bullion silver eagles, and even those are subject to allocation limits. Dealers can only order a certain number per week. We're observing the official sovereign mint of the largest economy on Earth admit that it cannot source enough silver to meet demand. Let that absorb. The entity that's supposed to be the backstop, the lender of last resort, the guarantor of supply, is tapping out. What do you think that executes to market psychology? What do you think occurs when the public recognizes that the United States Mint is rationing silver? It generates a feedback loop. Scarcity drives demand. Demand drives price. Price drives more scarcity as industrial users and governments hoard supply. And the retail sector gets crushed in the middle. We're in the early innings of this cycle. The mint repricing isn't the end, it's the beginning. Because if the mint cannot source silver at $90, what occurs at $120? What occurs at $150? Do they shut down entirely? Do they suspend silver eagle production? And if they execute, where does retail demand go? It goes to the dealers. It floods APMEX, SD Bullion, JM Bullion, and every other retail outlet. It overwhelms them completely. The mint failure is the accelerant on a fire that's already burning out of command. Now I desire you to imagine something. Imagine that you're sitting in a room with the executives of a major tech company, Apple, Microsoft, Google, Amazon. Select one. They're planning the construction of a $10 billion data center. This facility will house hundreds of thousands of servers. It will process artificial intelligence workloads. It will run machine learning models. It will power cloud computing infrastructure. And every single component in that data center requires silver. The circuit boards need silver. The semiconductor packages need silver. The connectors need silver. The switches need silver. Silver isn't optional. It isn't a cost-saving alternative. It's the highest performance electrical conductor in existence. Without silver, the data center cannot function at the speed and efficiency required for AI workloads. Now the executive poses the procurement team a simple question. How much will the silver cost? The procurement team runs the numbers. At current prices, the silver for the entire project represents 0.05% of the total budget. It's a rounding error. It's invisible. So the executive states, secure the supply. I don't care what it costs. We cannot afford delays. We cannot afford shortages. Make sure we possess the metal. This is the dynamic that's breaking the silver market. Industrial users don't care about price. When the metal is mission critical and represents a tiny fraction of total project cost, they'll pay $50. They'll pay $100. They'll pay $200. It doesn't matter. The project cannot proceed without it. And there's a new category of industrial demand that didn't exist 5 years ago: artificial intelligence. AI data centers are the most silver-intensive infrastructure projects in human history. A single hyperscale data center can consume millions of ounces of silver, and the tech giants are constructing hundreds of them. Microsoft is spending $80 billion this year on AI infrastructure. Google is spending $75 billion. Amazon is spending $60 billion. These aren't hypothetical budgets. These are committed capital allocations. And every single dollar of that spending generates silver demand. The analysts on Wall Street haven't updated their models yet. They're still calculating silver demand based on jewelry, silverware, and solar panels. They haven't accounted for the AI build-out. They don't recognize that the cloud is lined with silver. But the tech companies understand, and they're not purchasing silver on the COMEX. They're not calling it PUNITIVE. They're going directly to the source. They're signing long-term supply agreements with refiners. They're securing offtake contracts. They're securing their metal before it enters the public market. This is why COMEX inventories are collapsing even as prices elevate. The silver is being diverted. It's being pulled into strategic stockpiles. It's being eliminated from the available supply before retail purchasers ever obtain a chance to bid on it. And here's the critical aspect. The silver isn't coming back. When you construct a data center, that silver is embedded in the infrastructure for 10 or 20 years. It's not recycled. It's not recoverable. It's secured away. This is permanent demand destruction. Every ounce that goes into an AI server is an ounce that disappears from the circulating supply. We're observing the physical market bifurcate in present time. On one side, you possess the industrial users who are securing supply through private contracts. On the other side, you possess the retail purchasers who are fighting over the scraps, and the scraps are running out. APMEX is imposing a $500 minimum because they cannot obtain enough inventory to serve small purchasers. The Mint is repricing at $173 because they cannot source blanks. The coin shops possess lines out the door because local purchasers cannot discover metal online. The infrastructure is failing because the physical silver is disappearing into industrial black holes. And the market hasn't priced this in yet. When it executes, $93 is going to appear like a gift. But before we obtain swept up in the euphoria of rising prices and industrial demand, we need to inject a heavy dose of reality into this conversation. Because everything I've just described, all the bullish fundamentals, all the structural scarcity, all the demand destruction, none of it guarantees a smooth path higher. In fact, it guarantees the opposite. It guarantees violence. Let me transport you back to December 29th, 2025. We had just broken through $80. The sentiment was precisely the identical as it is presently. Everyone was broadcasting that $100 was inevitable. The charts were perfect. The fundamentals were perfect. The narrative was perfect. And then the trap snapped shut. In a single session, the price dropped 16%. It fell from $80 all the way down to $70. Billions of dollars in retail capital were vaporized. Everyone who purchased the breakout on margin was liquidated. Their accounts went to zero. Fast forward to January 8th. The price had recovered, and we were back at $80. The bulls were back in command. And then it occurred again. Another smash, another rug pull. The price crashed 12% in hours, dropping to $74. Now examine last week, January 15th. We hit $93, and we were euphoric. By lunchtime, we were trading at 86, a 7% drop in a matter of hours. Do you perceive the sequence? Every time we hit a new high, the counterattack emerges. December 29th, down 16%. January 8th, down 12%. January 15th, down 7%. This isn't random. This is algorithm. This is predatory. The banks possess access to the order book. They can perceive precisely where the stop losses are clustered. They understand that if they push the price down $5 or $10, they'll trigger a cascade of automatic liquidation orders. They utilize leverage against the leveraged. They push the snowball, and your stop losses transform it into an avalanche. So here we are at $93, the highest price in modern history. And the risk of a washout is higher today than it was yesterday. The more people who pile into the long side, the easier it is to tip the boat. I'm not informing you this to frighten you. I'm informing you this to protect you. If you purchase a futures contract at $93 and the banks engineer a 10% correction, the price drops to $83.70. If you're on 10-to-1 leverage, a 10% movement wipes out 100% of your capital. You're done. You're out. And the cruelest aspect? The next day, the price bounces back to 100. The fundamentals kick in. The industrial demand reasserts itself. The shortage becomes undeniable, and the price recovers. But you're not there to perceive it. You're washed out at the bottom. This is the vertical trap. The banks cannot cease the long-term trend. They cannot print silver for Microsoft. They cannot fake industrial demand. But they can still succeed in the short-term battles. They can still inflict maximum pain on tourists who think this is easy currency. This is why we constantly emphasize the communication of physical ownership. The investor who purchased physical silver on December 29th at $83 didn't obtain margin called when the price dropped to $70. His silver didn't disappear. He waited. And today he's up 12%. Physical silver possesses no leverage. It possesses no stop losses. The banks cannot hunt it. When you maintain the actual metal, you're immune to the flash crashes. A $10 drop on the COMEX is just commotion. It doesn't affect your ownership. We're entering a period of extreme volatility. The $93 level is a target. We could perceive swings of $10 or $15 in a single session. If you wake up tomorrow and silver is down $8, will you panic? If the answer is yes, you're overextended. The trend is up. The destination is triple digits. But the road from 93 to 100 is paved with traps. We've now arrived at the final piece of this puzzle. You comprehend the retail collapse. You comprehend the mint failure. You comprehend the industrial demand shock. You comprehend the violence. Now you need to comprehend the exit strategy. Because when you're sitting on a 300% gain and the price is climbing every single day, the natural human instinct is to liquidate. You initiate executing math in your head. You multiply your ounce count by 93. You consider what you could purchase with that currency. Stop. This is the instance where most people lose. They trade a scarce asset for an infinite currency. They swap the lifeboat for a ticket back onto the Titanic. Let me be very clear. The dollar isn't the destination. The dollar is the victim. Silver isn't becoming expensive. The dollar is dying. When silver shifts from 70 to 93 in 19 days, that's not silver appreciation. That's currency devaluation. You're not becoming wealthier. You're just maintaining buying power while everyone around you becomes more impoverished. So rule number 1 is simple. Don't liquidate for dollars unless you possess an immediate, unavoidable need for cash. If you liquidate your stack and leave the proceeds in a bank account, you've accomplished nothing. You've traded metal for paper, and the paper's devaluing faster than the metal is appreciating. Rule number 2 is the ounces to acres strategy. You liquidate when you can exchange your silver for a cash-flowing hard asset. You trade ounces for acres. You swap your metal for real estate that generates income. Historically, in 1980, it required roughly 800 ounces of silver to purchase the average home in the United States. Today, even at $93 per ounce, it still requires approximately 4,500 ounces. The ratio hasn't compressed yet. We're not at peak relative valuation. You wait the instance when you can walk into a real estate closing, hand over a monster box, and walk out with a deed. That's when you trade. You're swapping one form of generational prosperity for another. Rule number 3 is the most significant. Prepare for cash settlement. If you maintain a futures contract, an ETF share, or an unallocated pool account, you need to read the fine print. Every single one of those products possesses a clause that permits the issuer to settle in cash if physical delivery becomes impractical. When the price hits 150 and there's no metal available, they'll compose you a check and close your position. Then you'll attempt to accept that check to a dealer and purchase physical silver, and you'll discover that the street price is $300. You're paid out in a currency that can no longer access the asset. This is why physical ownership is non-negotiable. It's the only form of silver exposure that possesses zero counterparty risk. Nobody can default on a coin in your hand. We're at $93. The psychological magnet of 100 is pulling us higher. The fundamentals point to continued strength. The industrial users are desperate. The retail infrastructure is collapsing. The mint is tapping out. Everything points up. But the banks are observing. They're awaiting maximum euphoria. They might engineer one more flush to 85 or 88 to shake out weak hands. If that occurs, don't despair. Examine your stack. It's still there. It weighs the identical. It shines the identical. A paper crash is a gift. It's one last opportunity to trade dying dollars for living metal before the price becomes untouchable. The train is advancing. Maintain your position. Don't permit them to trick you out of your metal at the instance of victory.